we are seeing some familiar signs such as a series of aggressive interest rate hikes, and there are economists who argue that the lost decade is coming. So it's no doubt by now the word bear market is everywhere in the stock market, and your account is probably feeling the heat from it by now. Yes, we are in a bear market, but what in the actual world is a bear market? How often does this happen? How long will it last? And will this turn into a recession or even worse, a lost decade? Stick with me until the end because I'm gonna cover all of that in this video. But just before we begin, a quick tap of the like button below helps the channel a lot. Thank you so much for that. And without further ado, let's dive right into it. So by definition, a bear market technically starts when there's a price decline of more than 20% from the peak, which resembles the motion of a bear swiping their paws downward. Hence the name bear market. And when you hear someone use the word bearish, then you know they are probably expressing a negative sentiment and think that the market is heading towards a downtrend. And just in case you want to know, a bull market on the other hand happens when there is a recovery of more than 20% from the bottom, thanks to the motion of the bulls attacking by bringing their horns upward, hence the name bull market. Pretty simple, right? As of the recording of this video, the S&P 500 is down close to 20% from its peak in late 2021. We did recover a little bit, but that is still borderline bear market, where most of our favorite stocks, especially tech stocks, are down by a significant portion. So how frequently does a bear market happen, and how long do they usually last each time? Well, according to research, there have been 26 bear markets since 1928. 27 if you count the one we are in right now, and they said that a bear market will typically emerge every 3.5 years or so. If you put that into perspective, that is not too bad actually, considering the gains that the S&P 500 index have netted over the past couple of decades. Bear markets don't typically last too long, around 289 days on average, which is about 10 months give and take, while another source said that the bear market since 1950 has lasted an average of 603 days, which is almost 2 years in duration. However, one fact you need to know is that since 1928, bull markets generally last upwards of 991 days on average, which is almost 3 full years, and this essentially means that over time, you are generally more likely to win if you stay invested in the S&P 500 index. But of course, please take this with a grain of salt, as past performances do not indicate future results. As I've mentioned earlier, bear markets occur when there has been a price decline of more than 20% from the peak. But what are the other signs that a bear market has begun? Well, most investors watch for these 3 economic signals: rate of hiring, wage growth, and interest rates. When the rate of hiring and wage growth is lowered, this could be a telltale sign that a bear market is here or is coming. For example, when the pandemic hits back in 2020, businesses are forced to close down due to the lockdowns, while the supply chain also took a big hit because major ports in China were forced to shut down thanks to the COVID risk. So it's pretty obvious the result of all of that madness will lead to massive unemployment or wage cuts, because businesses can't afford to hire as many people as before, since their revenue for the foreseeable future will be cut significantly. And besides that, interest rates play a crucial role in determining bear market. When the economy is turning sour, the Federal Reserve will usually lower interest rates in order to stimulate the economy before an expected bear market turns into a full-on recession. When interest rates are lowered, there will be more borrowing, which leads to an increase in spending, since it's now cheaper to buy a car, get a mortgage, and etc. And on the business front, businesses can now employ more people since their financing cost is lowered, and they can now promote people left and right in order to grow their company. And that is almost like a dream come true for most people, where employees win, employers win, the country gets richer, and the party goes on forever, right? Well, not really, because if the lower interest rates goes unchecked for an extended period of time, inflation will be the next big problem, and that is when the economy can put on a reverse gear and U-turn very quickly to bite us back. Don't forget, the Fed's dual mandate is to introduce moderate long-term interest rates in order to combat inflation and keep unemployment at a minimum. And when we have high inflation with a potential of high unemployment rate, when the interest rates rise sharply in the next few quarters, we could very well enter into a stage that we call stagflation, which is what the US economy experienced in the 1970s. As you can see, both lines for inflation and unemployment were high at the same time. And after a decade of combating that, the Fed during the 1980s and 90s successfully brought inflation down from double-digit levels to the average rate of about 2% per annum. But just for information, when inflation is too low, it's not necessarily a good thing as well. Back in 2003, when inflation was close to the 1% mark, the Fed noted that any further substantial decline in inflation could hold the risk of causing impactful disruptions to economic activity and employment. Hence why in their door mandate policy, it's important for the Fed to balance economic activity as well as keep inflation in check, because a low and predictable inflation rate is necessary for the US Feds to monitor employment, inflation, economic development, as well as labor productivity. Remember that early on in this video I mentioned about the lost decade? Yeah, let's talk about that, because yes, a recession can be disastrous for a 12 to 24 months period, but a lost decade can be equally bad, if not worse than a recession. Allow me to explain that. The lost decade is a term used to describe the decade-long economic crisis and stagnation that happened in Japan during the 1990s. After World War II in the late 1940s, Japan's economy skyrocketed in the subsequent decades and peaked during the 1980s. And during this time, Japan's GDP per capita was among the highest in the entire world alongside the US and Britain. At that time, Japan experienced a trade surplus with the US, which means they were exporting more to the US than they were importing from the US. So in order to help offset that imbalance, Japan joined the other G5 nations in the 1985 Plaza Agreement, which was meant to manipulate the exchange rates by depreciating the US dollar to push up the Japanese yen and the then German Deutsche Mark. As a result of this agreement, Japan was very loose with its monetary policy, which allowed the valuation of their stock market and real estates to soar to the moon uncontrollably until the 1990s, when everything came crashing down and the bubble finally burst. And to counter that, the Bank of Japan raised interest rates, which shocked the entire Japanese economy. And after a series of cutting interest rates as the real estate value was still appreciating, to raise the interest rates to save the economy from downward spiral, it was a little too late already. The decade that follows from 1991 to 2003, it was a period of economic stagnation that averaged at a 1.14% per annum of economic growth for Japan, hence the name Lost Decade. So it's scary to think, with all of the bad news regarding inflation and the bear market going around, is the US heading towards the same direction? To be honest, it's hard to say. We are seeing some familiar signs, such as a series of aggressive interest rate hikes, and there are economists who argue that the lost decade is coming, while on the other hand, you have people saying that bull markets often follow after bear markets. A great example would be in 2002, when the S&P 500 bottomed, just to follow on with the bull market that lasted 2.5 years with more than 50% gain within that period. The same thing happened in 2009, when the S&P 500 price almost doubled in 2 years after declining 57%. So it's really difficult to say, and no one is correct 100% of the time. So wrapping up this video, there is a possibility that the bear market could potentially turn into a recession, or even worse, a lost decade. But above all, since a lot of things are out of our control, we can only do our best to control whatever's within our reach, such as 1. Don't panic sell when everything falls in a sudden, look for buying opportunity instead. 2. Maintain a healthy cash buffer of say 10 to 20% in times of uncertainty like now. And 3. Dollar cost average, because it works best especially in a downtrend market. Check out this video to learn more about it. Okay, with that said, thank you very much for watching. Stay safe, stay invested, and as usual, I will see you in the next one.